Okay, I want you to picture something for a moment. Picture the financial district of, well, any major city.
Right.
Doesn't matter where. New York, London, Singapore. You're standing there on the pavement, just looking up.
And you see these colossal buildings, glass, steel, just pure capital.
Exactly. The physical manifestation of capital. You see these huge towers, sprawling shopping complexes, maybe even one of those windowless fortresses we call data centers.
It is the ultimate asset class, really. It's tangible, you can touch it, you can see it, but it's also incredibly expensive.
And that's the thing. It feels so exclusive. The natural assumption when we look at that skyline is that ownership is just. It's reserved for billionaires.
Or institutions.
Yeah.
Sovereign wealth funds, huge insurance companies.
Right. It feels completely out of reach for the average person with a brokerage account.
And for most of history, that was the reality.
Yeah.
I mean, real estate is lumpy, it's illiquid, it requires massive upfront capital. If you had $5,000 to invest, you couldn't buy a fraction of an office building.
You could maybe buy a shed.
Maybe. A very small one.
But, and this is where our deep dive begins today, that is not entirely true anymore. There is a legal structure, a fascinating mechanism that was actually born from a cigar tax bill in the 1960s, of all things, that allows anyone to own a piece of that skyline.
You are talking about the Real Estate Investment Trust.
The REIT. The REIT. That is our mission today. We are going to unpack this beast. We're going to look at how really a tax loophole turned into a global phenomenon that now exists in over 39 countries, holding trillions of dollars in assets.
And we're going to get into how these massive entities work, why they're legally required to give you almost all of their money, and the specific mechanics that make them so different from buying a normal stock, like Apple or Tesla.
It's a subject that really rewards a closer look. I mean, on the surface, it sounds incredibly dry, real estate investment trust.
It does. It sounds like something out of an accounting textbook. But it really sits at this fascinating intersection of tax law, urban development, and what people love to call the democratization of finance.
Democratization of real estate is the marketing slogan for sure. It sounds noble. But looking at the research we have today, I have a feeling you're going to ground that enthusiasm in some pretty harsh realities.
Oh, I think we have to.
Realities of tax codes, interest rate sensitivities, leverage profiles. It's not all sunshine and dividends.
It isn't. While the concept is absolutely about access, the machinery that makes it run is all about tax efficiency and capital structure. It's not just about owning a building. It's about how money moves through that building, how it avoids the tax man, and how it lands in an investor's pocket.
So let's start right there with the definition, but let's go beyond the dictionary version. We know a REIT is a company that owns income-producing real estate. But how is this different from, say, McDonald's? McDonald's owns billions in real estate.
That is the crucial distinction. McDonald's uses its real estate to sell burgers. Walmart uses its real estate to sell goods. For them, the building is a cost center, a means to an end. A REIT's sole business is the real estate itself. It owns, operates, and sometimes finances income-producing property. The key is that the revenue must come primarily from passive rent or mortgage interest, not from an active business operation like slipping burgers or selling clothes.
So it's a pure landlord model.
Essentially, yes. Think of it like a mutual fund for bricks and mortar. A mutual fund pools money from thousands of people to buy a basket of stocks.
Right. You get diversification without having to buy every single stock in the S&P 500 yourself.
Exactly. A REIT does the same thing, but it pools money to buy a portfolio of physical buildings. So instead of you buying one rental property and having to deal with that 3 a.m. phone call about a broken toilet.
Which is everyone's nightmare.
It is. Instead, you buy a share of a company that owns 1,000 apartments, and it has a professional management team to handle all the toilets.
And the asset classes here are just wildly diverse now. We're not just talking about office blocks and shopping malls anymore.
Oh, far from it. That was the industry 40 years ago. Today, the REIT universe covers almost every single sector of the economy.
Like what? Give me some examples.
Okay, you have data center REITs, which are basically the physical backbone of the internet. They own the buildings that house all the servers for cloud computing.
So they're renting space to Google and Amazon.
Precisely. You have cell tower REITs, which are really more of a infrastructure play. They own the towers and lease space on them to AT&T, Verizon, and so on.
That feels less like real estate and more like a utility.
It has that characteristic, for sure. Then you have healthcare REITs owning hospitals, medical office buildings, senior living facilities.
And I saw in the notes we even have timber REITs. Weyerhaeuser is the big one that comes to mind,
Correct.
which has always fascinated me because it really blurs the line between real estate and agriculture. But the IRS is okay with this. They treat the timber as the asset and the harvest as the income.
Exactly. As long as the land produces the income, it can fit the structure. They even have REITs that own outdoor advertising billboards. If you can charge rent on it, someone has probably tried to turn it into a REIT.
Okay, so we've got a company. It owns a diverse set of rent-generating assets. But let's get to the magic sauce. The reason these things exist isn't just because people wanted to pool their money. It's because the government gave them a golden ticket. Let's talk about the golden rule of REITs.
The golden rule, or as it's often called, the 90% rule. This is the core of the whole structure. In the United States, and this template has been copied pretty much globally, to qualify as a REIT and keep that special status, a company must distribute at least 90% of its taxable income to shareholders as dividends.
90%. Let's just sit with that for a second. When you say that to a tech investor, their head explodes.
Right.
Amazon, Google, they pay zero dividends. They reinvest everything back into the business to grow. Why on earth would a company agree to this kind of financial straitjacket that forces them to give away 90% of their profit every single year?
Because the carrot is absolutely worth the stick. And the carrot is tax avoidance on a massive scale.
The universal motivator.
Always. Here's the math. In a normal corporation, what we call a C corporation, you have the problem of double taxation.
Okay, walk me through that.
So a normal company earns $1 of profit. First, the government takes a bite at the corporate level. Let's say the corporate tax rate is 21%, so Uncle Sam takes 21 cents.
Right.
Then, the company distributes the remaining 79 cents to you, the shareholder, as a dividend. But it doesn't end there. The government then taxes you on that dividend income you just received.
So that same dollar gets taxed twice. Once inside the company, and again when it hits my brokerage account.
Exactly. The government takes a bite at the corporate level and another bite at the personal level. A REIT, however, strikes a deal with the IRS. The government says, look, if you agree to pass at least 90% of that profit directly to the shareholders, we will not tax you at the corporate level.
So the first layer of tax just disappears.
It vanishes. The REIT pays zero corporate income tax. Zero. As long as they follow the distribution rules. So the taxation only happens once, at the shareholder level, when you receive your dividend. It makes the REIT an incredibly efficient pass-through vehicle for income.
And that explains why the dividend yields on REITs are usually so much higher than the broader market, like the S&P 500.
They're structurally designed to be income hoses. They have no choice.
Now, we need to make one important distinction before we move on. We've been talking mostly about equity REITs, the ones that own the actual physical buildings. But there's a second, smaller, and much riskier category.
Ah, yes. The mortgage REITs or MANZs.
Right. I wanted to touch on this. Aaron's don't own the building. They own the paper, the debt.
Correct. They don't own property. They finance it. They'll buy mortgages or mortgage-backed securities. Their business model is much more like a bank or a hedge fund.
How so?
They borrow money at short-term interest rates, lend it out at long-term rates in the form of mortgages, and then they pocket the difference. It's called the net interest spread.
Which sounds great until the yield curve inverts or credit markets seize up.
Exactly. They are far more sensitive to interest rate volatility and credit risk. For the purpose of our discussion today about owning the skyline, we're really focusing on equity REITs.
And the financial world has kind of formally separated them, right?
It has. It was a huge validation for the industry. Back in 2014, S&P Dow Jones and MSCI, the big index providers, actually moved equity REITs out of the generic financial sector and gave them their very own headline sector.
Which was the market saying, this isn't just a niche financial product anymore.
It was the market saying, this is a fundamental pillar of the economy. It signaled that real estate is a distinct asset class, with its own drivers, completely separate from banks or insurance companies.
So we have this vehicle. It avoids corporate tax, it pays high dividends, and it owns everything from malls to cell towers. But how did we get here? You mentioned a cigar tax bill earlier. I need the full story on that because it sounds like typical legislative sausage making.
It is the absolute definition of legislative sausage making.
Oh.
We have to go back to the United States in 1960. The Eisenhower administration is in its final year.
Okay. 1960, the Cold War is on, Mad Men era. What's the context?
The context is important. At the time, if you were a small investor, you were completely locked out of commercial real estate. You could buy a home, maybe, but you couldn't buy a shopping center. The only people who could were the ultra-wealthy, through private syndicates.
So the intent of the law was genuinely populist.
It was at its core. Congress wanted to create a way for the little guy to invest in large-scale, diversified commercial real estate portfolios, much like mutual funds had recently allowed them to invest in stocks.
It's about access.
It's about access. But the legislative vehicle for passing this revolutionary idea was a rather mundane revenue bill, Public Law 86779. And in the halls of Congress, it was known informally as the Cigar Excise Tax Extension of 1960.
So they tacked a revolution in real estate finance onto a bill about tobacco taxes.
That is often how Washington works. You attach your pet project to a must-pass bill. Eisenhower signed it, and the REIT was born.
And who is the first one out of the gate?
The first one was called American Realty Trust, founded in 1961 by a man named Thomas J. Broyhill. And it's probably no coincidence that he was the cousin of Joel Broyhill, a Virginia congressman who was a major champion of the legislation.
Of course. History is always about who you know. But here's the thing. Looking at the chart of the industry's growth, it didn't just explode in the 60s. It sort of plodded along for decades. It wasn't until the 1990s that we see what they call the modern REIT era. What changed?
The tax law again. But this time, it was about solving a very specific problem for the big real estate developers. We need to talk about the UP rate.
The UP rate, Umbrella Partnership REIT. Now, the notes explain this as a way to defer taxes, but walk me through the mechanics. Why was this the aha moment?
Okay, let's create a scenario. Imagine you're a real estate tycoon in 1990, a big developer. You own 10 shopping malls. You built them years ago for a total of, say, $10 million, and now, after years of appreciation, they're worth $100 million.
A nice problem to have.
A very nice problem. But you are asset-rich and cash-poor. Your wealth is all tied up in these buildings. You want to cash out, or maybe you just want to diversify. But if you sell those malls to a newly formed public REIT, what happens?
You trigger a massive tax bill.
A massive capital gains tax event. You have to pay tax on that $90 million gain immediately. It's a huge financial hit.
That's the friction cost. You lose a huge chunk of your wealth just to get liquid.
Exactly. So for 30 years, the big developers refused to sell their portfolios to REITs. The best assets stayed private. The UP REIT, which was invented in 1992 by a mall company called Taubman Centers, created a sort of currency swap mechanism to get around this.
How does that work?
Instead of selling the malls to the REIT for cash, the tycoon contributes the malls into a new entity called an operating partnership. The REIT itself is the general partner of this new entity, but the tycoon gets special units in exchange for his properties. Let's call them OP units.
And these units are worth money.
They are economically equivalent to the REIT's publicly traded shares. They get the same dividend. But technically, legally, they are not stock. And because they aren't stock, the IRS views this whole transaction as a contribution to a partnership, not a sale.
So, no tax event.
No tax event.
That is incredibly clever. So the tycoon gets a currency, these OP units, that's basically as good as stock, and he keeps his gross wealth intact. He only pays the tax years later if and when he decides to convert those units into actual shares and sell them on the open market.
Precisely. It's a tax deferral machine. And once this structure was approved by the IRS, it opened the floodgates. All these massive private real estate empires, the Simons, the Zells, the Taubmans, suddenly had a tax-efficient way to take their empires public.
So that's why the market cap of the industry just exploded in the 90s. It wasn't just new buildings being built, it was all these private assets finally moving into the public sphere.
That's it. It was a transfer of existing wealth from private hands to the public market.
Okay, that brings us to the next major stress test for the industry. 2008, the global financial crisis. Real estate was ground zero. Logic would dictate that REITs should have been completely wiped out.
And they were certainly hammered. I mean, share prices collapsed 70, 80% in some cases. But the aftermath is what's really interesting. It actually proved the resilience of the public model versus the private model.
How so? If I was a private landlord in 2009, I was in deep, deep trouble.
If you were a private landlord with a big mortgage coming due in 2009, you were basically dead. The banks were not lending to anyone. You couldn't refinance. You had to hand the keys back to the bank. But the public REITs had a superpower.
The stock market.
The stock market. They could print new shares.
Right. They could raise equity.
Exactly. They re-equitized. Even though their stock prices were in the tank, they could still go to the market and issue new shares to raise cash. And investors were willing to buy those shares at those depressed prices because they knew the underlying assets were good, the companies were just over-leveraged.
So they raised tens of billions of dollars.
Tens of billions in 2009 and 2010. They used that cash to pay down debt, to clean up their balance sheets.
So they diluted the existing shareholders, which is painful.
Very painful.
But they saved the company.
They survived. And that ability to access capital when the debt markets are completely frozen is probably the single biggest advantage of being a publicly traded REIT.
Which transitions us perfectly into the mechanics of investing today. We know they survived. We know they pay high dividends. But I want to play devil's advocate here for a second. We talked about that 90% payout rule, like it's a great thing for investors. But isn't it also a massive operational risk? Well, if I'm running Google, I keep my profits. I have billions in retained earnings. If a recession hits, I have a war chest of cash to ride it out. But if I'm running a REIT, I've legally sent 90% of my cash out the door every single year. I have no retained earnings. If the credit markets freeze up again, aren't I just fundamentally fragile?
You have just hit on what the industry calls the payout trap. It is the existential risk of the entire sector.
So it's a real thing.
Oh, absolutely.
Yeah.
Because they cannot retain earnings in any meaningful way, they are structurally addicted to external capital. To grow, or even just to refinance existing debt, they constantly need to go back to the well-issuing new shares or selling new bonds.
So they are completely at the mercy of market sentiment.
Completely. If the stock market crashes, their cost of equity goes through the roof. It becomes too expensive to raise money by selling stock. If interest rates spike, their cost of debt goes up, they can become paralyzed, unable to grow or refinance.
So what do they do when those capital market windows slam shut?
They have to turn to something called capital recycling. This is a buzzword you will hear on every single REIT earnings call.
Okay, what does that mean?
It means selling your mature or lower quality assets to generate the cash to buy new, higher growth assets or just to pay down debt. You have to cannibalize parts of your own portfolio to keep the machine running because you can't just save money from your rental income.
That sounds incredibly stressful. Speaking of stress, let's talk about interest rates. This is the classic textbook correlation. Rates go up, REITs go down. Why is that relationship so consistently strong?
It's strong for two main reasons. The first one is mechanical and pretty obvious. REITs, by their nature, carry a lot of debt to buy these big buildings. Higher rates mean higher interest expense, which means less cash left over for dividends.
Simple math.
Simple math. But the second reason is more psychological, and it's about competition for your investment dollar.
The bond substitute argument.
Exactly. Think about the mindset of a typical REIT investor. They're often retirees or people looking for yield. Safe, steady income. Now, if a REIT pays a 4% dividend and a risk-free U.S. Treasury bond pays only 1%, the REIT looks fantastic. You're willing to take the extra risk for that extra 3% of yield.
But if the Federal Reserve raises rates and that Treasury bond suddenly moves to 5%,
then why on earth would you buy a risky real estate stock that only pays 4%? You wouldn't. Money flows out of REITs and into the safety of bonds. So, to compete, REIT stock prices have to fall until their dividend yield rises high enough to be attractive again relative to that new, higher bond yield.
so it's a repricing mechanism. The market is forcing the yield up by pushing the price down.
That's it. Now, it's not always that simple. There's a counter-argument,
Which is?
which is that why rates are rising matters. If rates are rising because the economy is booming and inflation is high, REITs can actually be a pretty good hedge.
Because they can raise rents.
Because they can raise rents to keep up with inflation. So their income stream is growing, which can offset the negative impact of higher rates. But in the short term, a sudden spike in rates is almost always painful for the sector.
Okay, let's get into the weeds of the numbers. If I'm a new investor, I pull up a REIT ticker on my screen, and I look at the PE ratio price to earnings. It often looks broken. I might see a PE of 80 or 100. For a normal stock, that means it's insanely expensive. But you're telling me to just ignore that.
Ignore it completely. In fact, if you invest in REITs using PE ratios, you will almost certainly make bad decisions. The entire problem is with the E in PE, the net earnings.
And this goes back to depreciation.
It's all about depreciation. Let's do an explained apartment like 5. Imagine you buy an apartment building for $10 million. For tax and accounting purposes, the IRS rules say the building has a useful life of roughly 27.5 years.
Okay.
So every year you get to tell the taxman, my building lost about $360,000 in value this year due to wear and tear. You deduct that from your rental income.
Even if, in the real world, the building actually went up in value because the neighborhood got trendy.
Exactly. That's the key. In reality, Well-maintained buildings usually appreciate. But on paper, for accounting, they depreciate. It is a non-cash charge. It's a phantom expense that reduces your reported profit.
So your net income on the financial statements might show zero or even a loss. But in reality, your bank account is full of rent checks.
Your bank account is full of cash. Net income, for a REIT, is an accounting fiction. It creates a massive distortion, and that is why the industry invented its own metric. FFO.
Funds from operations.
Funds from operations.
And the math there is pretty simple, right? You just take the net income and you add the depreciation back in.
That's the main part of it, yes. You take net income, you add back the depreciation and amortization, and you also subtract any one-time gains you might have made from selling property, because that's not recurring income. That gives you the FFO. That is the industry's baseline for cash flow.
But it doesn't stop there. Then there's AFO, adjusted funds from operations. Why do we need yet another acronym?
Because FFO is, frankly, a little too optimistic. It adds back all the depreciation. But in the real world, buildings actually do wear out. Roofs leak. Parking lots need to be repaved. The carpets in the hallways need to be replaced every few years.
These are recurring capital expenditures, CapEx.
Exactly. These are real cash costs you have to spend just to maintain the quality of your property. AFO is a more honest metric because it subtracts that necessary recurring maintenance CapEx from the FFO.
So AFFO tells you the true cash flow that's available to be paid out as a dividend.
It's the safe number. If a REIT's dividend is higher than its AFFO, you should be very worried. It means they are borrowing money or selling assets just to pay you. That is a dividend cut waiting to happen.
Okay, so AFO is the key. One last metric before we start our world tour. NAV, net asset value. This seems critical for knowing if you're getting a deal or not.
It is the anchor for valuation. NAV is simply the estimated market value of all the properties the REIT owns, minus all of its debt. It's the breakup value. If they sold everything tomorrow and paid off all their loans, what would be left for the shareholders?
And the fascinating thing about the stock market is that the share price can drift wildly away from that NAV.
That's where the opportunity is. Sometimes the market is pessimistic, and a REIT might trade at a 20% discount to its NAV. That means you are literally buying $1 of prime real estate for 80 cents.
And the big private equity firms like Blackstone, they live for this.
They love this. They look for REITs trading at deep discounts, buy the whole company, and take it private, arbitraging that gap.
And conversely, if it trades at a premium to NAV, that's a signal to management that they should be issuing shares like crazy to buy more stuff.
Exactly. It's their cost of capital advantage.
Okay, we have the definition, the history, and the investor's toolkit. Now let's look at the map. This is not just a U.S. story anymore. You mentioned 39 countries have adopted this model. Let's do a rapid-fire global tour, starting here in the Americas.
Well, the U.S. is the heavyweight, obviously. Over 190 public REITs. It's the most mature market.
Yeah.
Let's look south to Mexico. They have FIBRAs.
FIBRAs, Fideicomiso de Infraestructura y Bienes Raíces.
You've been practicing.
I try, but looking at the structure, they seem, I don't know, more rigid than the U.S. model.
They are. They were introduced in 2011, modeled on the U.S., but with much tighter guardrails. For example, the payout requirement isn't 90%, it's 95%.
Wow, even less margin for error.
And they have very strict rules about holding periods. A FIBRA generally must hold its assets for at least 4 years. The Mexican regulators wanted to prevent speculation and flipping. They wanted these to be long-term, stable infrastructure players, not traders.
And the first one was Fibra Uno.
Yes, and it became this massive conglomerate of industrial, retail, and office assets all across the country.
And then Brazil. Brazil has a feature that makes U.S. investors incredibly jealous.
The FIIs, or Fundos de Investimento Imobiliario. And yes, the killer feature there is tax-free dividends for individual investors.
Completely tax-free, no strings attached.
There are a few strings. You have to be a personal investor, not a corporation, and the fund has to have at least 50 shareholders and be publicly traded. But if it meets those criteria, the income is tax-exempt.
In a high-inflation, high-interest rate environment like Brazil, that tax shield must be incredibly powerful.
It's created a massive retail investor culture around FIIs. You have regular people on YouTube in Brazil who are basically day trading these things because that tax-free income stream is so attractive.
Okay, let's move north to our neighbor Canada. They had a bit of a drama with something called the SIFT tax. This feels like a real lesson in regulatory risk.
It is a textbook case. In the mid-2000s, Canada had a broader structure called income trusts, and they became too popular for their own good. Regular operating companies, telecoms, energy companies, even restaurants started converting into trusts just to avoid corporate tax.
So the government realized it was losing its entire corporate tax base.
The Ministry of Finance woke up one day and saw a giant hole in its budget. So they cracked down hard in 2006 with these new SIFT rules specified investment flow-through. They slapped a new tax on these trusts that effectively killed the advantage of converting.
But REITs were spared.
This is the key. They carved out a specific exemption for trusts that held real property. So the real estate trusts were saved, but the energy trusts and business trusts got hammered. It's a stark reminder that these tax loopholes exist entirely at the pleasure of the government. They can be closed at any time.
Let's jump across the ocean. Let's talk about the Asia-Pacific region. Who are the big players here?
Well, the real pioneer outside the U.S. was Australia. They launched what were called listed property trusts, or LPTs, way back in 1971. They're a massive part of the Australian stock market, the ASX. But I think the most interesting strategic player in the region today is Singapore.
The S-REITs. I was reading that they're increasingly becoming global landlords. What does that mean?
It means that because Singapore is a tiny island, there's a physical limit to how much real estate you can buy there. So to grow, the S-REIT regime has always encouraged cross-border ownership. Today, you can buy a Singapore-listed REIT that owns data centers in Ireland, logistics parks in Japan, or shopping malls in mainland China.
So Singapore acts as the financial hub, but the actual assets are scattered all over the globe.
Correct. And investors, particularly international ones, really favor them because of the strict regulatory oversight from the Monetary Authority of Singapore. They impose a hard cap on leverage, the gearing ratio. It used to be a firm 35%, it's varied a bit since then, but it prevents the kind of cowboy leverage you sometimes see in other markets.
Now, we have to talk about China, the second largest economy in the world. Massive construction, but they were surprisingly late to the REIT party.
Very late. They only launched the public pilot program in 2020 and 2021. But the flavor of the Chinese REIT, the C-REIT, is totally different from what you see in the U.S.
How so?
In the U.S., REITs are primarily about commercial real estate malls, offices, apartments. In China, the government is pushing REITs specifically for infrastructure.
So not apartment buildings, but toll roads and sewage plants.
Exactly. Toll roads, industrial parks, logistics warehouses, energy pipelines, waste treatment facilities.
Why that specific focus? Why not open it up to the residential or office market?
You have to think about the macroeconomics. For the last 30 years, the Chinese state and local governments have been on the world's biggest infrastructure building spree. Trillions and trillions of dollars are now trapped in that concrete. By launching REITs, they can securitize a toll road, sell it to public investors, and get their cash back.
So it's a deleveraging tool for the state. They're cashing out.
Precisely. It recycles capital so they can either build more infrastructure or, more likely, pay down the massive debts that local governments have accumulated. It's not really about helping you own a condo in Shanghai. It's about fixing the state's balance sheet.
That is a critical distinction for an investor. If I buy a C-REIT, I'm buying a stable, utility-like cash flow, not a bet on rising rents in a booming city.
It's a very different risk profile. Correct.
What about some of the other countries in the region? I saw some notes about friction costs in places like India and the Philippines.
The Philippines is a classic case of a zombie law. They passed a REIT law way back in 2009. But the regulators got greedy. They put in all these restrictive tax policies, like requiring that if a developer put land into a REIT, they had to pay a huge value-added tax and other taxes immediately.
So the friction cost was just too high to make it worthwhile.
Exactly. Nobody used it. For 10 years, the law existed on the books, and there were 0 REITs listed. It was a complete failure until 2020, when the government finally said, okay, we'll relax the tax friction. And only then did the first one, a REIT from Ayala Land, finally launch.
A clear lesson for policymakers. If you want a market to develop, you have to lower the toll at the gate.
Indeed. India had similar issues, where the initial rules were skewed so heavily toward institutional investors that retail investors were largely shut out. They've been slowly fixing that over time.
Okay, let's head back west, Europe and the Middle East. The UK feels like a country that should have been an early adopter, but they weren't.
No, surprisingly late. 2007. And they had a strange quirk. To convert your existing property company into a REIT, you had to pay the government an entry fee of 2% of the gross value of your assets.
A 2% cover charge just to get into the club? That's hefty.
It was. But the big established players like British Land and Landsec paid it because they calculated that the long-term tax savings of being a REIT were worth more than the one-time entry fee. That charge was eventually abolished in 2012 to make the market more attractive.
And what about Germany? I know the German housing market is very unique, a very high percentage of renters, strong tenant protections. How did that shape their version of the rate?
Germany is the great skeptic of the REIT model. There was huge political resistance, especially from the Social Democratic Party. They were terrified that locust investors, their term for private equity and REITs, would buy up all the apartment buildings and jack up rents on German families.
The fear of financialization.
That's the heart of it. So when they finally passed the REIT law, also in 2007, they included a poison pill to protect tenants. REITs are legally forbidden from owning any residential properties that were built before January 1st, 2007.
Wait, say that again? They can't buy the existing housing stock.
No, they can only buy newly built apartment buildings or commercial properties. The vast majority of German apartments, the entire existing stock, is off limits to REITs by law. It was a political compromise to protect tenants from the perceived evils of the capital markets.
That is absolutely fascinating. You can play in our sandbox, but don't touch the old stuff.
It's a very German solution, and as a result, the REIT market has remained very, very small and niche.
Okay, finally, let's go to Dubai, a city literally built on real estate speculation.
But a city with a very complex legal map. The REITs there, like Emirates REIT, are domiciled in the DIFC, the Dubai International Financial Center.
That's a free zone, right, with English-style common law.
Exactly. But the rest of Dubai, where all the buildings are, operates under local UAE civil law. And this created huge headaches initially. A DIFC-based REIT couldn't legally own properties outside the zone unless it had majority local ownership.
A classic jurisdiction mismatch. How did they solve it?
Emirates REIT, which was run by a dot-com entrepreneur, had to engineer this very complex platform structure with local partners to satisfy those ownership rules, which finally allowed them to actually buy buildings in the rest of the city.
And on top of all that, they are Sharia compliant.
Yes, that adds a whole other layer of complexity. They cannot use conventional interest-based debt. They have to use Islamic bonds or sukuk, and they cannot lease their properties to tenants that engage in haram or forbidden activities.
So no banks that charge interest, no alcohol sales, no gambling.
Right. So a hotel REIT in a Sharia structure might have a problem with the lobby bar. They would likely have to structure it so that a third party operates the bar and the REIT itself doesn't touch that specific revenue stream. It's complicated.
So we've gone from the U.S. to Mexico, Brazil, China, Germany, Dubai. We have a global market now worth something like $1.7 trillion.
At least. It's a huge asset class.
And we have all these different flavors: infrastructure focused in China, strict tenant laws in Germany, tax-free income in Brazil. But it all comes back to that same simple idea from that 1960s cigar tax bill.
The chassis is the same. A tax-efficient pass-through vehicle. The bodywork just differs by local culture and politics.
Yeah.
It really shows how a country's legal and social priorities shape its financial markets.
So let's bring this all home for the listener. We've talked about the mechanics, the pros and cons. We've talked about the risks, the payout trap, the sensitivity to interest rates. But I want to end on a more philosophical note, if we can.
Let's hear it.
We started this conversation by saying this democratizes real estate. It lets me, the little guy, own a piece of the mall or the data center. And that sounds great. But as this model expands, especially into single-family housing, which is a booming REIT sector in the U.S. now, are we crossing some kind of line?
You're talking about the financialization of home debate?
Exactly. If a company like Invitation Homes has a fiduciary duty to maximize dividends for me, the shareholder, that means they have a legal duty to raise rents as much as the market will bear. And when that asset is a shopping mall, nobody really cries for the tenants. But when that asset is a starter home in Atlanta where a family lives,
it changes the social dynamic completely. You have the cold, hard efficiency of Wall Street applied to what many people consider a basic human need or even a human right.
Right. So the provocative thought I want to leave with the listener is this. When you buy a residential REIT, you are celebrating that efficiency. You are cheering for the 90% payout. But you also have to ask yourself, are we turning our cities and our homes into pure financial instruments? Is the skyline just a ledger of tickers on an exchange?
It's the ultimate trade-off, isn't it? The benefits of liquidity and access for investors versus the potential social cost of the commodification of community. There's no easy answer.
It's something to chew on the next time you see a for rent sign managed by one of these massive corporate landlords. You might actually own a tiny piece of it. Thanks for diving deep with us on this. It was fascinating. We'll see you on the next one.
And stay curious.